Well, let's go ahead and get started. Thank you guys for joining today. We'll have more jumping in here in a moment. Today, we have with us Justin Renfro of Wefunder. He's the Senior Director of Growth and was previously the Director of Partnerships. Thank you for joining us here today, Justin, and looking forward to our discussion.
Thank you for having me. I'm excited to be here, and it's nice to meet everybody.
Great, thanks. So let's kick off and tell us more about yourself and Wefunder.
I'm an entrepreneur myself. I started my career at a nonprofit called Kiva, which facilitates interest-free microloans to entrepreneurs all over the world. I led Kiva's U.S. expansion from 2011 through 2017. In 2017, I moved to San Diego and started my own boat charter business. So I've got a boat empire down here in San Diego. Still own and operate chill charters, and that was a really fun experience. And my core team from Kiva moved to Wefunder when I left to start the boat business, and they brought me on 3 years ago. So I've been leading partnerships and business development at Wefunder for the past 3 years. Really, it's a simple equation: find awesome founders and help them execute successful raises on the Wefunder platform. So I've got a team of 10 that I work with, and spend a lot of time just working with startups, working with partners, working with funds, working with angel groups, and helping kind of connect all the dots. I really see myself as a matchmaker and a connector. Wefunder, sorry, go on.
Go ahead.
Yeah, Wefunder is a platform that allows entrepreneurs to raise capital. I think there's kind of three main pieces to the puzzle. The first is we make it slightly easier by kind of facilitating all the legal and compliance around a raise, kind of facilitating that in-house as a value-added service. The second is helping founders raise faster. That's both via our network of investors. 35% of the capital on average comes from Wefunder's network of investors. And the other component to speed is allowing founders to cast a wider net and bring more people into the mix. Wefunder was really founded on the principle of allowing accredited and unaccredited investors to invest side by side, and that's really the ethos of the company. We're a public benefit corporation, and that's an important aspect of our mission. And then the third kind of cornerstone of the operation is around marketing, and that's just getting your company out to more people and creating more engagement, more activity, more impressions around the business, which can open new business, new doors, new business, new activity, beyond fundraising.
Well, tell us more about community rounds. I see that on the Wefunder website. Give us more detail about what that is and how that works.
The core ethos of a community round is allowing your customers to invest in the company. I think that's really where the leverage is for companies fundraising on our platform, is allowing your customers to invest. And if they invest, they're going to be bigger advocates. They're going to buy more. They're going to talk to more people about it. So it's a really kind of savvy marketplace in that you can convert any of your customers to invest in the company and find new investors that are going to become customers. So it kind of works on both ends, where you're raising capital and it's customer engagement, it's marketing, it's exposure in a very unique way that drives a lot of business value. So at the end of the day, I think that executing a successful community round is a very, very strong signal to the market that you have a product that people enjoy and that people want to put money into, and it's a very positive signal in the market.
That's great. So what companies do well on crowdfunding?
Well, I think the obvious answer there: consumer facing companies. Mercury Bank. It's a new tech. It's a tech startup in San Francisco. They have bank infrastructure for startups. They sent one. So a lot of times when you say consumer facing, you think of CPG, but I think it's like any business with a community, any business with a lot of customers can benefit, from our platform. Mercury Bank sent one email to all of their customers and raised $15 million in 3 hours, which is a really positive signal that, there's a lot of kind of buy-in from the customers that they have. So I think that's probably the cleanest product market fit. Generally speaking, we're working with companies in the seed stage through the Series A. You have a lot of companies that are raising their seed round. You have a lot of companies that are building bridges to the Series A. They're buying themselves more runway. And then you see, the third piece is like another avenue of capital for the Series A. So seed to Series A, generally consumer facing or customer centric companies. That's where you see the cleanest product market fit.
Great. So what's the key to running a successful campaign? If you raise that much money in just a few hours, you're doing something right. What are we doing to learn from?
I think it's really just like, it's hard to recreate sending an email and getting $15 million in capital. I think you have to be a very special company with a big audience of very engaged users to be able to accomplish something like that. That isn't the typical use case on Wefunder. I think the kind of core elements of success across the hundreds of campaigns that I've worked on are a really savvy ability to tell your story. I think storytelling is such an important aspect for startups, for fundraising, and for business. I think that the ability for you to kind of articulate, this is who we are, this is why we exist, this is the problem we're solving, this is the solution, this is the traction, this is the team, like packaging that in a very like refined way is particularly important, especially on a platform like Wefunder where you're competing with other startups. It's kind of like you need to tell a good story, but I think it translates far beyond just crowdfunding. This is just like how to be successful as a startup. You have to tell a good story. So storytelling is a big piece of it. A second kind of core component is kind of having a strategy for how you're going to build momentum. The leverage is in, how do we get to new investors? How do we get Wefunder investors to participate in our round? How do we accelerate the fundraising process? And if you're starting from nothing, it can be very, very hard to execute a successful raise. So typically for most companies, there's kind of two core elements. You basically have investors, previous investors, new investors you're talking to, angel groups, folks that are coming into the mix. And then you've got your customers. And those are going to be the two primary buckets that you have at your disposal to help build momentum around your raise. And I think that having a very thoughtful way to bring both of those, to kind of generate momentum within both of those buckets is kind of the key to success in a lot of ways. And storytelling obviously influences that in a big way. So I'd say those are probably the two most important kind of patterns across hundreds of campaigns and who's done well and really maximize the opportunity.
It seems like size of network is a key factor. You have to have a meaningful network in order to raise from. And how big should that network be before someone should say, yeah, I'm ready to raise, or I'm not ready? What's your experience there?
It really depends. The strategy is a lot different if you're looking to raise $5 million than if you're looking to raise $100,000. So there's a lot of nuance, and it is a pretty big spectrum of the types of companies that you see or that we engage with. At super broad strokes, I think it's best practice to have 30% of your round soft circled going into it. So it's like, all right, cool. Based on all the investor conversations we're having, based on all the conversations I'm having with friends, family, professional network, based on the customers that we have a lot of confidence that, we can come to Wefunder with 30% of the capital of our target kind of soft circled and ready to go. I think that's generally the best formula to kind of predict success. It might be a little bit different if you're looking to raise 5 million, or it might be a little bit different if you're looking to raise 100K. But I think that's a good broad stroke.
How much time should you spend preparing for a campaign before you launch it? You know, it seems like it's to get 30% is going to take some time, and then getting the documents, materials, and successful campaigns. How far in front are they starting?
Generally, it's 2 to 3 weeks of setup before you get your first check in the door. You know, putting your campaign page together, getting a video, obviously it can span, you know, kind of like, to what extent is this your priority? I think, you know, regardless of crowdfunding, I think founders should carve out 6 to 8 weeks of like, I'm going to be, fundraising is going to be my top priority for 6 to 8 weeks. And you really, you know, as a founder, you're so kind of stretched. You have so many competing priorities. You have so many things that you're trying to manage. And a lot of times it's hard to carve out 30 to 40% of your time to execute, you know, to execute a fundraise. You have to make a lot of sacrifices, and there's a lot of trade-offs. But for a motivated founder that's kind of in that fundraising mode, you know, the actual setup is quite easy. You know, putting together a campaign page, if you've got an updated pitch deck and you've got your kind of like, you've got a good grasp of the story that you're selling, you know, for this round, translating that on Wefunder is quite easy.
And several people develop a fair amount of digital assets to use in social media, email, and so forth. What do they need to be putting together on that front?
I think like, it's really about content. So content is, you know, like on Wefunder, we have an update section where you can actually talk about what's happening with the business this week, what's happening with, I look at a Wefunder campaign page as a more dynamic pitch deck. There's an open forum for Q&A. There's an opportunity for companies to post updates. There's videos, there's testimonials. There's a lot of creativity that can go into telling your story over a prolonged period of time. I'm always encouraging founders. It's like, hey, answer all the questions that are being asked and give weekly updates, give visibility into what's happening with the business every single week. Highlight the wins, highlight the momentum, highlight the traction that you're seeing. So I think it's really just like, it's kind of a content heavy where it's like, hey, we have to send emails, we have to post updates, we have to, you know, engage in the Q&A. So I would say like writing is probably the biggest lift. And a lot of times it's not pre-existing assets. It's just like, this is how we're going to communicate. This is the schedule. This is what we need to put together, you know, in the context of a raise on a platform like this. It's all about just like, you tell the story of the business and then you break it into bite-sized pieces and kind of, you know, kind of feed the beast, to, you know, for lack of a better term, where it's like, we're talking about different components of the business. We've got a long form podcast style webinar that we're going to give to interested investors. We're going to have weekly updates highlighting momentum and traction. I think that's really, from an asset standpoint, that's what you really need to, you know, have a plan for. And we've got a lot of consultants. I've built a external network of consultants that, you know, kind of guide founders through that process. So you can hire someone to be like, all right, cool, this is how we're going to tell your story. These are all the different things that we need to do. And then let's figure out how to divide and conquer. And, you know, those run the spectrum from full service to very light.
That's great. And social media is a key element in these campaigns. How does it fit in, and what should you do to prepare for it?
I think paid media is relevant, but not that relevant. I think that if you're a consumer-facing brand with a product to sell and your LTV is high, where getting a new investor to come in and then them being a customer, if there's high potential there, you're kind of killing two birds with one stone from a marketing perspective and running paid ads to drive visibility and traffic to your campaign page, knowing that I can convert an investor to a customer. So I think for companies where that kind of stepping, when those stones make sense from a pathway, paid media is relevant. Typically, you're seeing I would say 4x on average. You're kind of shooting for 6-7x return on ad spend. So the cost of capital can get really high with paid ads, which is why I don't really like it. But if it's serving the business and driving new customers and driving revenue, then it makes more sense. So paid media is more of an economic argument. It's an economics question where it's how much is this costing us? How much are we getting in investment volume, and how much do you think we can get from revenue as a byproduct of paid ads? So a lot of parallels to e-commerce paid ads, where it's all right, cool. There's an economic model here, and we're trying to figure out how to best layer in different strategies to drive more exposure and more investors into the mix.
So if you're trying to drive to, say, $1 million raise, some portion comes from the issuer's network, some from Wefunder's network, and some from other networks. What do you think of the rough cuts between those three that someone should plan on getting for a $1 million raise? So it's substantial beyond just your network.
Yes and no. I mean, 36% of the capital on average comes from Wefunder's network of investors. So that's, call it roughly 2/3 from the founder and the company, and 1/3 from Wefunder. Within those 2/3, there's a lot of ways that can play out. Sometimes it's very heavy on the customer side. Sometimes it's very heavy on traditional angel funding. Sometimes it's very heavy on paid media. So you kind of mix and match based on the assets that you have to say, how are we going to raise 60 to 70% of our target? Here are the different avenues. Which avenues make the most sense for us? And you see a lot of variety there. Sometimes paid media is a very heavy piece of that. Sometimes it's none of it. A lot of times it's none of that. Generally speaking, I kind of spoke to two core buckets. You've got previous investors, angels, personal, professional network, and you've got your customer base. It's well, how big are those two relative buckets, and can we quantify that and at least have a vision for how we think this might play out? And that's what myself and my team work with founders on, is helping them kind of deconstruct a goal where it's okay, 35% coming from Wefunder. How do we get that other 2/3? What are the different assets that we have available to us?
Great. And anybody in the audience has a question, please post it and we'll be glad to answer it as well. So we also work with angels and angel groups. How do those fit in? I assume you start with your own network and then spin out to others, but how would you approach the angel world with it?
It's very similar to syndication, where if we have an interesting deal, there are different networks that are connected to Wefunder that are interested in seeing deal flow. And my baseline has always been, I think it's relevant and valuable for founders to have options. And I think that what Wefunder does is an interesting option. It's a relevant option. It's one that they should know, kind of what are the nuances as it applies to me. It's quite easy, at face value to be if you're a consumer facing company and you've got a big community and you're a community oriented company, you should really look into this option. So it's really about deal exchange, where it's who am I talking to that might make sense for you? Who are you talking to that might make sense for us? And trying to form symbiotic win-win relationships with angel groups, where it's all right, cool. This is what you're looking for. Well, we're talking to hundreds of startups at any given time. We've probably got 200 to 300 companies that are fundraising live on Wefunder, and we've probably got 300 to 400 companies that are in the process of exploring Wefunder or in the early stages. So, I'm talking to 15, 20 startups a week right now. And just having that kind of ability to, hey, I saw this over here. This is something that's happening over there. It's like, it's all about networks and finding the right deals and the right companies and the right founders and the right connections. So, my BD strategy at Wefunder is like, we want to be super connectors. We want to be able to matchmake and facilitate that value-added connections for our founders and for our partners. And angels are obviously a big piece to it, because they're talking to relevant startups, generally in the seed to Series A stage. And that's our sweet spot. That's our product market fit. So there's a lot of relevance.
That's great. So you have a Test the Waters program. What's that all about?
Yeah, so testing the waters essentially allows founders to raise capital without doing any legal or compliance work. The biggest hurdle to raising capital on a platform like Wefunder is the SEC requires 2020, 2021 reviewed or audited financials, depending on how much you want to raise. That's typically, call it a 5K spend and 2 to 3 weeks to put together. In the process of getting those financials, you can fundraise in parallel. So testing the waters allows you to send an email to your customer base and see how much demand or appetite there might be. Then you can make the decision as to whether you want to raise. So it just gives more flexibility to founders to be able to decide, hey, I'm going to float this around. I can talk about the raise. I can send people to the campaign page, and I can push the compliance and legal stuff down the road a little bit until I have more confidence that this is the option that I want to move forward with. So I think it's all about just like being really flexible and easy for founders, where it's like, hey, if you have an updated pitch deck and you've got a lot of those kind of like core storytelling elements in place, you can put a campaign page up on Wefunder very, very quickly and start testing the waters. It's very true to its name in that you can kind of tease it out, but the baseline is basically like you can start fundraising in parallel to doing the legal and compliance work.
Well, in addition to Reg CF crowdfunding, there's also Reg A plus crowdfunding. Who do you recommend go for the Reg A? The vast majority do CF, but I think some fit the Reg A. What do you tell people that you would say, hey, you got to think about that?
I think Reg A is only relevant if you have a very large community.
How large?
In the I would say $10 million plus. So if you're like, hey, we're going to raise from our customers and we think we can raise $10 plus million, Reg A is the route that you should explore. I don't feel that it's super relevant for most companies. Wefunder has a policy where if you launch a regulation crowdfund and hit the max of $5 million and there's still demand and there's appetite and people want to keep accepting money, we'll host a Reg A for free so that you can continue to access that upside. And I really like that strategy because raising $5 million generally is not very easy. And the regulatory requirements for Reg CF are very low compared to Reg A. So you can raise that 5 million, get a real idea of how much appetite and demand there is in the process of getting to that 5 million, and then have the open option to extend it into a Reg A, and Wefunder hosts that for free.
That's great. Well, you can raise a certain amount in a year and before the regulation cuts you off. How many people come back and do a follow-on raise the next year, the year after that? What kind of follow-up rates are we seeing these days?
Rough idea is probably like 50 to 60% of the successful campaigns I've worked on have come back and raised a second round. I think founders really see the benefits of having all of these people engaged with the business. It's not just about the capital. It's also about all the other stuff that happens, the PR, the random reach outs. It's just like there's a lot of visibility, there's a lot of exposure, and that's what gets flagged more often. with successful campaigns, it's just like, oh, so many new business opportunities, so much good exposure, so much good energy around this investor base. And Wefunder makes it quite easy in that all of the compliance and legal, all the investment contracts, the SPV post raise, it's one line on the cap table. It's a very efficient process for founders. So if the demand is there and the story is connecting, why wouldn't you run it back to continue to raise until you're at the point where you can go the VC route and you're ready for institutional capital? But a lot of times it's not as clean as seed to Series A to Series B. A lot of times, you have kind of undefined rounds and a lot of bridges, and you're trying to figure out product market fit. Because a lot of times when you get to the institutionals, those things have to be solid. And it's generally not a clean pathway to get to product market fit and amazing metrics. Like, the reality is, with most startups, they're pivoting. They've got, they're figuring out the people component. They're figuring out the strategy. They're making a lot of decisions. So those bridge rounds of $500K or $1 million that open up 6 to 9 months of runway, that's very typical in today's funding environment.
Great. Well, you mentioned that crowdfunding works well for consumer-facing goods and so forth. What do you think about going into ESG, environmental social governance, and climate tech and alternative energy, and some of the newer things that are coming out that may not be so consumer, but still very important to people?
Yeah, climate and clean tech are probably our most popular vertical for our investors. If you were to take like CPG, your bread and butter CPG, I've got a granola company, it's at $1 million in revenue. A lot of times angel investors aren't as interested in investing in those types of companies because there's not a technology component. It's hard to scale. Mm-hmm. I think generally the more kind of like traditional angel you are, in that you have a technology component, you have a scale component, there's a clear kind of vision for what an exit could look like. Those are the companies that generally get more pickup from Wefunder's audience. There's a lot of parallels in kind of like the deals that are attractive to angels are also more popular on Wefunder and vice versa. So with clean tech especially, you've got there's technology, there's scale, there's an environmental impact. So it's impact investing to an extent. And I think that's just a very attractive combo. So I think, if you're a granola company, you have this amazing benefit to be able to raise from your customers, which is an awesome opportunity. And it really expands the ability for founders to raise. But on the other side of the spectrum, that's generally where you're going to see more demand from our investor audience, and more pickup is like companies that have that, those core elements that the typical angels in that category look at.
But it seems like every year there's more and more companies that are bringing an impact to the deal in addition to a product or service. I don't know the exact numbers, but it seems like it's going up as a percent of companies. It just seems like that's the general mood. What's your take there? What are you seeing?
Well, I came from Kiva, which is a nonprofit, so very impact oriented. A lot of our partnerships were in that space. Wefunder is a public benefit corporation, so we're particularly keen and fond of the impact space. It's an area that there's a strong ethos of the culture and the people at Wefunder around the impact category. It's cool if you can make a lot of money and make an impact. So I think Wefunder naturally attracts a lot of those types of companies. I'm particularly fond of that category and looking for partnerships in that category. One of my favorite kind of like investment groups in the world is called Endeavor. They focus on Series A impact investing, Series A plus. So I think, it's like, for the same reason that it's interesting and appealing to you, it's interesting and appealing to us.
Right. I remember when Kiva first came out many years ago, I actually put in $25 and I backed an Uzbekistan taxi driver. And then 6 months, 9 months later, they had paid it back. And so I took the money and I backed an Ethiopian restaurant and then got the money back.
Yeah.
And then I did a third deal, which was a women's clothing shop. So it's always helping somebody get in there. And what really drove it was not the return, but the fact that you could participate with other people.
Yeah.
And how much do you see that with Wefunder is the participation factor is what's driving it, not the return?
Uh, well, the return is tricky, as you know. Uh, Especially when you're in the seed stage, I think the typical like life cycle to from inception to liquidation is 10 years. Um, the law has, we haven't really gotten our, we got going really in 2020 when we were able to unlock one line on the cap table. So that's what really started to drive higher quality deal flow through Wefunder and more serious, legitimate companies. So we're so early in that kind of returns question, where I, I I think it's an unknown right now as to kind of like, are these types of companies that are raising on our platform going to generate big returns for our investor base? I certainly hope so. I think that's a very important piece of the equation. I don't see Wefunder as a nonprofit. I don't see Wefunder as a gift. I see it as an investment in the company, and that's the lens by which we look at and work with founders that engage with us. And I think that a lot of time, yeah, the average raise on Wefunder is $450,000. So these companies are raising serious checks from serious angels, and they're getting follow-on funding from, a broader pool of investors. But there's a very serious element when you're raising $450,000. It's very different when on Kiva, the average raise was $4,000. It was branded and executed as a charitable way to help entrepreneurs. This is a completely different category that is no different than an angel group.
Well, as an angel investor, they have a saying, an angel wants to make a little money, have a little fun, and do a little good. And a little bit of everything
Exactly.
makes for a winning investment. So
Amen.
even if angels are primarily looking for a return, they also want to have some fun, and they want to contribute to the society in some way, shape, and form. And it seems like some of that element also goes into the crowdfunding world. They're bringing some of those things to the table as well.
100%. I mean, like, that's why I love this space. Is you get to talk to the CEO, you get in at the ground floor, and you get visibility and exposure and engagement in a totally different way than a public company. And I love being able to kind of like see someone's dream and see someone's vision. And now that I've been at Wefunder for 3 years, it's even cooler. It's like, hey, 6 months, a year, 2 years, 3 years down the line, you actually see them, making these huge strides and leveling up. And it's a beautiful thing. It's so much fun. It's why I love startups. That specifically, it's like I'm having a lot of fun helping founders pursue big ambition.
That's great. If anybody in the audience has a question, go ahead and post it. We're getting near the end of our time here, but wanted to wrap up with a few more questions, but give anybody else a chance as well. So we're seeing a lot of interest in crowdfunding from many different groups, not just consumer and so forth. I see biotech up there. I see cybersecurity up there. I see defense projects up there. I mean, just a wider range of things are coming up there. What do you think is driving it at this point? Is it really wanting a broader base of investors, or is it a testing the waters thing? What do you think is putting biotech and those others up there?
Pragmatism. If Wefunder is going to help a founder raise faster or raise easier, it's like, hey, we make it easy for founders. It's just like you have a website URL, a very sleek checkout flow. Anybody can participate. It's one line on the cap table. All the investment contracts are managed by Wefunder. it's a very pragmatic decision for founders to be like, well, this simplifies my life. This makes it a little bit easier. If 35% of the capital is going to come from Wefunder, that's 35% less capital that I have to go find myself. So I really see it as a pragmatic, kind of a pragmatic option for founders. And that's again where it's like, I want founders to have options. I want them to have different routes that they can entertain. A lot of times it's a complicated puzzle and there's a lot of pieces to that puzzle. And there's a lot of conversations being had. And for a lot of founders, it's like, this is a convenient thing for me to have in my back pocket for the right conversation that I have. So I think pragmatism drives our business more than anything as a byproduct of, the ease on the back end and the speed on the front end.
Great. Well, coming from the angel world, last I checked, you had to be an accredited investor, and that was about 5% of the population or less. It may have moved, but inflation and other reasons. But what percent of the population you think is actually invested in a crowdfunding campaign in some way, shape, and form across all platforms and all functions?
Well, it's certainly a higher percentage than what it was before. I'm not sure to the extent. We had about, I think we're doing in the ballpark of like 10 to 15,000 transactions every single month on our platform. So that's a lot over the course of a year. We have about 50% market share. So you call that double, where it's like across the industry, you're looking at like probably 30,000 transactions from people all over the world that are participating in this way. It's a beautiful thing.
And how fast is that growing year over year? If you add that up at some point, that really becomes a substantial size of the population that are engaged with it. But what's the current growth rates?
It depends how I cut the data. Might have to have my colleague Johnny come in with his spreadsheets and give 7 different layers of that. Yeah, it's growing. 2020, our business exploded. We had the one line on the cap table coupled with COVID, everything going remote. It really kind of like decentralized angel networks around the country, and geography became a lot less relevant. And we saw 7 straight consecutive quarters of growth between Q2 2020 and Q4 2021. This year's been challenging. Markets are down. Investors are a little bit more kind of tight. So we're feeling the economic impact of the market downturns just like everybody. And it's been a tough quarter, but I'm really confident that there's product market fit, there's value, and this is a great option for founders, and more are going to be taking advantage of it.
Great. If there are any questions from the audience for Justin, let's go ahead and ask him now. We do have a startup that would like to give us a short pitch to bring in the startup flavor here and get your impressions of it, Justin, as well. Is this a fit for crowdfunding, and how might it work and go down? So with that, any other questions from the audience, go ahead and post them in there. And with that, let's go and switch over to James. James, thanks for joining us here from Prefix, and go ahead and show us your slides and take a few minutes and share with us what you're doing there.
Thanks, Hall. I'm glad my timing was good. Usually I'm like too early, too late. So great to be here. Thanks for having me. Let me just get the screen share going here. So as Hall mentioned, I'm James Bilodeau, founder and CEO of a company called Prefix. We're filling out an extension. We're close. We have a few hundred K left of a oversubscribed Seed Plus, and then starting our Series A raise right now. To put it simply, Prefix eliminates the hassle of home maintenance and saves our homeowners between 30 and 50% off home maintenance costs. Average homeowner spends about $3,000 and 30 hours a year on what's fundamentally a broken process of unreturned calls, service windows, exploitive pricing, and general confusion on what ongoing maintenance is needed in their home. It's one of the biggest consumer problems there is. Yet until now, there hasn't been much real innovation addressing what we feel is the actual problem. There are two incumbent models that have tried. Marketplaces, you've probably heard of, funded by contractors. They may lower search costs, but really address none of the problems we just mentioned. They use disparate independent contractors and simply can't control for quality. And then there are home warranties, which are really just bad insurance at odds with their customers' best interests. 4 out of 5 people churn off of these if they ever experience them. They make their margins by also using 1099 contractors willing to be undercompensated, or by denying claims to customers for any reason they can find. Neither model creates trusted relationships or the ability to monetize them. So how do we fix it? We make it as simple as possible for our members. The prefix, you get your own dedicated home manager. We hire primarily military veterans with impeccable records and a strong work ethic. If anything breaks, you just call, text, or email. Your home manager takes care of it, usually for just a small copay, around $40. No online searches, no contractor blind dates, no wondering if you've gotten the best possible price. Your home manager also comes to your home, performs a 30-point preventive maintenance twice a year. And by 30 points, I mean clean your AC condenser and condensate line, change your air and water filters, flush the sediment out of your water heater, clean the lint out of your dryer outtake, sanitize your washer and dishwasher with a natural cleansing agent, change all your batteries and your smoke alarms, and there's another 15 to 20 more things. For the minority of things that your home managers can't do, you get one of our vetted contractors, and we still manage them all the way through to completion. But as a homeowner, you get low negotiated rates with no markup. We've created a completely new model of home care by focusing on 3 main pillars. First, what I call our human code, or the repeatable processes around hiring, training, and motivating our full-time employees. We've gotten really good at this, and it takes advantage of the ongoing shortage of skilled tradespeople that most people feel in this market that afflicts all incumbent contractors in this space. Second, it's our technology platform. It goes hand in glove with our unique operating model. From the customer's perspective, we're super easy to communicate with, just like a friend or neighbor. We have the equivalent of Amazon one click to enroll in the service. Homeowners are able to see all the work we've done, even how much money we've saved them in the home health report. And finally, the data that we collect as part of our service on the homes that we serve means we know how to fix things right and can be almost predictive in the care that we give. So we're much more efficient. Third, is the way in which we create operational density. Those of you here in Austin, this is one of the neighborhoods we serve, the Mueller neighborhood. We have 1/3 of total homes in the original Mueller neighborhood. We don't know of many models that get this kind of addressability or operational density, and it gives us a unique advantage. There's a bit to unpack in each of these areas, so if anyone is interested in speaking after, happy to. Keep moving here. So we solve one of the biggest consumer problems there is, but home maintenance isn't the extent of a business model any more than books was that of Amazon's. By doing the work of solving the broken home maintenance process, we fund the creation of what I call an operating system for the home and trusted, sticky relationships with homeowners. We started with margins of around 30% through a monthly subscription and co-payments. We've been increasing these to 50% as we continue to offer other higher margin services. Late last year, we stood up our own full service HVAC installation company, sort of an Amazon basics of HVAC distributed through our primary care platform, a relationship with homeowners. It's very high margin. It's been super high NPS, saves our homeowners between about 20% off if they need a new HVAC system. The preventive maintenance of our existing service, our ability to install and maintain telematics like leak detection, lowers underwriting risk for insurers. And I'll tell you a little bit about a pretty exciting partnership we just launched. And then we'll be launching, as another example, solar lead gen and maintenance next in an increasingly energy constrained market. For those of you familiar with solar, photovoltaics are super cheap. It's this last mile of distribution, which includes trust and a complex sale to the homeowner that we're able to solve. The same data that serve our individual customers so well, highly valuable in aggregate to both consumers and industry partners. And we will only ever use it to serve our customers better. The data we already collect enables us to determine cost to own, market share for all appliances and systems in the home. Companies like Consumer Reports, JD Power, They make hundreds of millions of dollars from initial quality assessments, and our data is better. We're at over 3.4 million in annualized revenue now. We're 7 times larger than we were at the beginning of the pandemic and accelerating. We carefully and quietly refined our operating model and marketing playbook here in Greater Austin. We launched in San Antonio earlier this year, and as you can see, our city rollout is accelerating. Strategic partners we brought on are adding to this acceleration. Tell you a little bit more about those in a second. And then even as we've grown more quickly, we've maintained customer service levels that are unique in this industry, particularly for a startup. We have near perfect reviews online and an NPS of 85. Having worked on the repeatability of our operating and marketing playbook, we're now turning to more quickly capture what's a very large market opportunity. Core home maintenance market, $20 billion in the US. Adjacent markets into which we're expanding represent even larger opportunities. We've achieved Series A metrics with our own direct-to-consumer marketing playbook. But we're now entering a new phase of growth. We partner with both one of the largest and most well-respected insurers in the country. Happy to share in a smaller venue, but it's USAA. We started onboarding thousands of their members in San Antonio and Austin and soon Houston. And then a major public utility, which is NRG, and they'll be launching us in Houston next month. They have millions of customers in Texas alone. By distributing us, they instantly get us to profitability in any metro area in which we launch, and our CAC is almost zero. What's important is that we're highly strategic for both of them. This isn't an add-on. We don't have to coax them into selling something that's a little bit different or not core. For USAA, we reduce underwriting costs by like 20%. For NRG, we help them provide other energy-related services and escape the commodity trap of deregulated retail electricity. In addition to those, we've already been working with national real estate brokerages in discussion with home improvement retailers, builders, private equity firms, large real estate with large real estate holdings. And any one of these, or most of these, could eventually be acquirers. Finally, it's not a founder-led company, it's a team-led one. We've got some great folks. We specifically looked for those folks that have brought the experience for driving growth through the early stages of category creation when you're creating those repeatable processes. And now we're ready to scale. And I will pause here. I don't think we're taking any questions, but just quick summary of our traction, and I'll wrap it up.
Great. Thanks, James. If anybody in the audience has a question, please post it. Justin, what was your take on that presentation? What did you like? And how do you think that might work in the crowdfunding world?
Congrats on all your success. As a recent homeowner, I bought my house 2 years ago. I see the value. It's like almost immediately, like I want to buy.
Oh, thanks.
So there's a broad appeal. I think anyone that owns a house can resonate with the problem statement, and that really plays in your favor. I thought you did a really awesome job kind of going through the different pieces of the business. I would have loved to see this traction slide slightly earlier in the presentation to kind of anchor this is where we're at early on, where it's like, all right, cool. I was able to grasp exactly what you do very, very quickly. Maybe not exactly, but high level what you do, then go to traction and then start kind of like peeling the onion back from there versus waiting for the traction at the very end. That would be my only kind of constructive feedback. The appeal on Wefunder is, the play would basically be like, hey, we've got a lot of people that are using us. We have a lot of people that love us. They're probably going to want to invest if we give them the opportunity, and that could be very good for the business. There's a high level of virality with this type of stuff. Homeowners talk to each other and share resources. So the more people that you have that are, they're engaged, they're investors, that could be a very attractive channel. In addition to just like general marketing to the masses, where it's like, this is a big problem. Everyone can resonate with that problem if you've owned a house. So there's a very, very clear appeal. Plus, it's like we have traction, we have good investors, we're making headways. it should drive that, that appetite, if you take it to the crowd. So those would be the kind of interesting pieces that I might look at for, crowdfunding as a potential channel to help you raise the Series A. Now you might say, we're 50% of our way to our Series A. We're going to be able to hit it. I don't want to deal with the effort that's required to like put it on a platform and, send it out. So that would be why you wouldn't want to do it. So there's two sides of the coin. There could be a very, very savvy marketing play. It may not be worth it if if you have a ton of momentum on your current track. This might be a distraction.
Do you ever sort of geofence your campaign so that, we're in Texas, so it would be a campaign limited to Texas?
We don't, but there are ways to kind of like orient around Texas. There's different kind of strategies to be more targeted as to, so for example, let's say you sent this to all your customers and raised a couple $100,000. Then we send a dedicated email to all of our investors in Texas. Then you run a paid ads budget that's specific to Texas. So there are ways to kind of like curate the audience and the marketing to the market that you operate in.
Got it. Interesting.
Great. Appreciate the feedback there, Justin. And James, thank you for presenting today. If anybody in the audience has a question, let us know. We'll send everybody the recording so people can go back through this as well. With that, I'd like to go ahead and start wrapping it up a little bit. We're near the end of our time. James, thanks for pitching today. I thought it was a great pitch and looking forward to seeing you again at our next round. And Justin, we want to thank you for joining us today as well and giving us the update on Test the Waters community rounds and what Wefunder has going on, as well as how to be successful at Reg CF crowdfunding. More and more people are going in it, and it's a great way to raise funding, and glad to see you guys leading the charge there with it. And then those in the audience, want to thank you for joining us today. We'll be back in touch to see if you have any further questions for us, and love to help you out with whatever fundraise or investment you want to make in these deals as well. Any other questions or closing thoughts there, Justin?
No, I appreciate you having me on. Check out Wefunder, poke around, make $100 investment, kind of see what it feels and looks like. I think, interacting directly with the product and seeing what kind of deals are on there and how are they progressing, how are they storytelling, how does the investment process work? I think it's good learning if you're in the industry.
Great. Well, I want to thank everybody for joining us today. Well, with that, we'll go ahead and wrap it up. Thanks, Justin, for leading us off today, and looking forward to next steps with you. And James, thanks as well for your pitch. And with that, we'll go ahead and close it out. See you guys next time.
Thank you.
Cheers.